Welcome back to the Deep Dive. Today, we're taking a really fascinating look into a sector that's just ripe for high-tech innovation, urban agriculture.
Hmm.
We're heading straight into one of the world's most packed megacities, Metro Manila in the Philippines, and we're focusing on, well, a very ambitious venture. It's called Metro Green City Farm, fully automated vertical farming.
That's right. And we're really going to dissect their strategy, their business plan. Metro Greens, they're a registered corporation, got started back in 2021. And they're looking for a pretty significant investment right now. We're talking 58 million Philippine pesos.
Which is about, what, just over $1 million US dollars?
Yeah, roughly $1.026 million USD. And the goal is to scale up their operations. They're doing this automated vertical hydroponics thing. And, they've picked probably the highest stakes location you could imagine. The BGC district, Bonifacio Global City, very prestigious.
Okay, so our mission today is, well, it's really specific and honestly quite interesting. We're going beyond just the cool pictures of high-tech racks. We want to dig into the financial nuts and bolts.
Yeah.
How does their strategy, this multi-product approach they're doing, microgreens, mushrooms, nuts, dried fruit, wet greens, how does that, combined with what they call a conservative, almost pessimistic production forecast,
Yeah.
how is that supposed to generate big returns, especially in this huge market that seems, well, underserved?
Exactly. This is like a perfect case study in turning scarcity or maybe potential scarcity into high value. It really shows why guaranteeing supply hyper-locally in a place with, let's be honest, chaotic logistics. Why that's so much more valuable than just pumping out massive volume that might not even get there in good shape.
Right.
We're going to show you how selling what looks like, frankly, a surprisingly small amount of produce each day can actually translate into these really impressive projected profits. It's all because the market is just starving for consistency.
Okay, let's unpack this then. This is fascinating source material. So, in real estate, it's always location, location, location.
Yeah.
But for fresh produce, especially high-value stuff, it feels like it's even more critical. Metro Greens has set up shop in BGC, Bonifacio Global City. That's like the heart of corporate HQs, fancy condos, upscale restaurants in Manila. Why is that specific spot such a big deal for them? What's the competitive edge?
Well, it hits the weak spot of the whole Philippine food supply chain, basically. Distance and spoilage. You have to look at where Manila usually gets its fresh stuff, especially the delicate greens. The distances are just huge.
Yeah. Give us a sense of that. How far are we talking?
Okay, so the main veggie source is often the highlands, right? So places like Baguio up north in Luzon, that's like 240 kilometers away.
Wow.
Or maybe Tagaytay, which is closer, but still a good 64 kilometers.
Yeah.
Now, if you're shipping potatoes, maybe that's okay. But for something delicate, something living like microgreens or specialty herbs, that journey, it's forever in food miles.
Right. And that much travel time. You're talking days on a truck, bouncing around, temperature changes. It must lead to a lot of waste.
Right.
And the quality just plummets by the time it gets to, say, a fancy chef in BGC.
Exactly. The source material really hammers this point, that travel time means the produce loses nutrients, it loses visual appeal. It's just not premium anymore. Metro Greens, they just sidestep that whole problem. By being right there, centrally located, they slash delivery times. They're often talking about delivery the same day it's harvested.
The same day.
Yeah. They don't need the big, complicated national trucking network. They just use, the local guys like Grab and Lawmove, quick on-demand delivery.
So their main selling point isn't really price, it's just maximum freshness. And they get that because they're physically close. It's like the ultimate farm to table, except the farm is practically next door to the restaurant paying top peso.
Exactly. That speed, that guaranteed quality, it builds this huge competitive barrier. But then you add their technology choices on top of that location advantage, and it gets even stronger because it cuts out a lot of the external risks you face operating there.
Okay, so that leads us straight into the tech and the environmental side. We mentioned automated, high-tech vertical farming, hydroponics, controlled environment. So, okay, it saves space, obviously. But what other efficiencies does this give them, especially in, the challenging Southeast Asian climate?
Well, let's start with resources. Land use first. Hydroponics naturally uses way less land. You're stacking vertically in a city where space is super expensive, super dense, and crucially, water. It uses up to 90% less water compared to traditional soil farming.
90% less water. That's huge.
It's a massive efficiency gain, yeah.
And the second point you mentioned, protection from the climate.
This might actually be the biggest differentiator for them. The Philippines gets hit hard by extreme weather. You've got frequent typhoons, droughts, heavy monsoon rains. It's unpredictable. Traditional farms, they're totally exposed. Huge crop losses happen all the time. And for buyers like hotels or restaurants, that means supply is volatile. You just can't rely on it.
Yeah, a chef planning a menu for a high-end hotel in BGC can't deal with that kind of uncertainty. Maybe we'll have basil today, maybe not.
Precisely. But inside Metro Green's farm, climate controlled, totally immune to whatever typhoon signal is raging outside. Supply is continuous year-round. That reliability, that's gold to their B2B clients. They need stability more than anything, and there's more. Because it's a closed environment, no bugs or weeds get in, so boom, no need for pesticides or herbicides.
Right.
Which means the product is inherently cleaner, more sustainable, basically organic grade without needing the label. And that appeals directly to that premium, health-conscious customer.
So better logistics, climate-proof, cleaner product.
Got it. Now, who exactly are they selling this premium guaranteed stuff to? Who's the target market? And just how big is this demand they say is underserved?
Okay, it's kind of tiered. The primary audience is definitely the high-end B2B crowd. Think luxury restaurants, five-star hotels, those gourmet chefs in BGC, Makati, Ortigas, the fancy districts. These guys care more about consistent quality and knowing the supply is stable than they do about saving a few pesos. They'll pay a premium for ingredients that are both exotic and reliable.
Okay, that makes sense. And the secondary audience, that's more retail and like individual consumers.
Yeah, exactly. The big supermarket chains are key here. You've got the giants like SM and Robinson, sure, but also the more premium chains like Landers and S&R. Think Costco or maybe Whole Foods equivalent for the Philippines, catering to wealthier folks who like imported goods.
Right.
And then they also target health-conscious individuals directly. Athletes, nutritionists, parents wanting clean food for their kids, foodies, people who can order straight from their mobile app. What really jumps out, though, is this claim about the market status. The forces say demand for things like microgreens is growing fast, but Manila is still really undersupplied. Is it actually true that no one right now guarantees reliable daily delivery of this stuff?
That lack of a daily guarantee. That's basically the million-dollar gap Metro Greens is aiming to fill. Your traditional suppliers, even smaller urban farms, they often work on a batch system, maybe weekly deliveries, and they can still be affected by the weather, right?
Mm-hmm.
But a chef needs those pea shoots for dinner service every single day at 3 p.m., no excuses. Metro Greens, with their location and their tech, they can offer that critical daily promise. That stability is really the currency they're trading in. And that's how they plan to carve out this profitable niche in a megacity of over 35 million people.
Okay, let's pivot now to the core business strategy, this idea of a diversified product portfolio. It's not just microgreens, right? They're deliberately setting up multiple income streams. Why? To stabilize revenue, maximize order size. Tell us about these main product categories.
Yeah, diversification is absolutely central to their plan. It reduces risk, especially when they're just starting up and ramping up. It's kind of layered. Category 1 is microgreens. This is their main thing, their tech core, the profit driver. They're planning at least 7 types. Pea shoots are the big one. They expect that to be like 40% of their microgreens volume because it's popular and grows relatively fast.
40% just from pea shoots.
Yeah. Then they've got radish, Ramgo radish, broccoli, mustard, Mizuna, variety for those fancy chefs, you know?
Right.
And this category, microgreens, is projected to bring in the lion's share of the money, something like over 80% of their total revenue between 2025 and 2027.
Okay, so microgreens are the star. What else are they selling alongside that to, I guess, bulk up the orders?
Right. Category 2 is mushrooms, specifically high-value types like shiitake and oyster. They plan to grow these themselves in dedicated spaces within the farm.
Okay.
Then category 3 is nuts and dried fruit. Now, this is interesting. For now, the plan is to actually source these from other farmers and just resell them.
So they're not growing those themselves, initially at least.
Not initially, but it serves a purpose. High-end clients, like hotels and restaurants, they prefer dealing with fewer suppliers if possible. So by offering these other gourmet items that pair well, Metro Greens becomes a more convenient one-stop shop. It increases the average order value for every customer.
Smart. And the fourth category, wet greens and other stuff.
Right. Category 4, wet greens and other produce. This covers the basics that chefs use every day. Things like baby cucumbers, basil, mint, staples. But this category is also kind of their test lab. Long-term, the ambition is to grow really premium, harder-to-find crops. Think Japanese cucumbers, raspberries, even strawberries.
Wow, strawberries in Manila. That would be something.
Exactly. But they're being careful. Initially, they'll source these through resales, too. Test the market demand, build the client base first, before they sink the big capital needed to actually grow those complex things themselves. It's very measured, step by step.
Okay, this leads us to probably the most critical piece of the financial puzzle. Their calculations, their whole business plan, it's explicitly based on a pessimistic production scenario. They're saying, even if we only hit our worst-case numbers, we're still viable. Let's go over those specific daily volume targets again and really stress why they matter so much.
Yeah, this is key. They're building their financial case on the absolute minimum volume they think they can reliably sell every single day across these different products. And the numbers, when you hear them, might sound, well, not that huge for a city of 35 million. Mushrooms, just 40 kilograms a day. Baby cucumbers, wet greens, also 40 kilograms a day. Nuts and dried fruit, the resales, again, 40 kilograms a day. And then microgreens, the main engine, 80 kilograms a day.
Okay, 80 kilos of microgreens. Sounds like a lot if you're growing them at home, maybe. But put that in the context of Metro Manila. What is that total daily volume? 40 plus 40 plus 40 plus 80, so 200 kilos total. What does that actually represent in that massive market?
And this is the light bulb moment for the whole investment case. If Metro Greens just consistently sells that 200 kilograms a day of this mixed high-value produce, those volumes are tiny for the overall market.
Tiny.
Yeah. The analysis in the source materials is really clear on this. Those daily amounts, they would only satisfy the demand of maybe 1 to 3 major supermarket chains.
Just 1 to 3 supermarkets.
Exactly. Think about getting a contract to supply, say, the S&R branch in BGC consistently, or maybe lock in 2 or 3 specific Landers stores. That's potentially their entire pessimistic output covered right there. They're not trying to feed the whole city. They're trying to guarantee supply for a very small number of high-value buyers who are desperate for that reliability.
Okay, that completely changes how you look at the risk, doesn't it?
Yeah.
They're not basing their success on capturing some huge, uncertain market share. They're saying, we just need to reliably sell this very achievable amount to a tiny fraction of the potential buyers, and the numbers work.
Precisely. The sales risk drops dramatically because the target volume is so small compared to the total potential demand. If they can just nail down those consistent daily sales of those diversified products, 80 kilos of microgreens, 40 of mushrooms, 40 of wet greens, 40 of nuts fruit, the financial models show that leads directly to the high margins and the profits they're projecting.
Right.
They're essentially proving they don't need some massive sales explosion. They just need dependable everyday sales of high-margin items in a market where consistent quality is scarce.
Okay, let's look at the physical scale needed for this. What does the facility look like when it hits full capacity in 2027, according to the plan?
So the space requirement is 500 square meters. Not huge, but efficiently used. The core production comes from 25 of these specialized vertical racks or shelves, and those 25 racks give them a total of 1,800 individual growing slots. Now you combine that with the really fast 12-day growth cycle for microgreens.
12 days? That's quick.
Very quick. That capacity translates into a projected annual output by 2027 of nearly 60 tons, 59.91 tons to be exact, just of microgreens.
And even that 60 tons a year, I mean, it sounds like a lot, but in the grand scheme of Manila's food needs, it still reinforces that this is a niche, high-value play, right? It confirms they're about premium pricing and guaranteed delivery, not trying to compete on massive volume like traditional farms.
It's exactly that. It's strategic scarcity. They're not going head-to-head with the truckloads of tomatoes coming in from the provinces. They're competing on guaranteed freshness, exotic variety right there in the BGC financial district.
Yeah.
And adding the mushrooms, the nuts, the dried fruit, that just makes sure every client buying their microgreens also potentially buys more, making them stickier and boosting the overall profitability per customer.
Okay, moving beyond the actual farm setup. Metro Greens is clearly using its high-tech image in its sales and customer service, too. They're really pushing automation. Why is that such a big advantage, specifically in the Philippines market? You mentioned it can be a bit slow sometimes.
Yeah, the market can often rely on manual processes, phone calls, paper orders, which can be slow and prone to error. Metro Greens is building like a digital fortress against that. The sources say they're using 3 fully integrated CRM systems. There's Salesbox, which connects to their app and website for handling structured orders. And then they use Lilu.ai to manage all the interactions coming through social media, messaging apps like Telegram.
Lilu.ai. That sounds like more than just a standard chatbot then.
Oh yeah, it's designed to be much more, it's basically an automated order processing engine. So customers, especially individuals buying through the app, can place pretty complex orders 24/7 using bots on Facebook and Instagram. No human needed for the basic transaction.
Yeah.
The AI assistant handles common questions, processes simple requests, and this is important. It learns from every interaction, so it gets better over time. This speeds things up massively, cuts out human error in taking orders, and, significantly reduces the overhead you'd normally need for a big customer service team in a 24/7 operation.
That sounds really efficient. So how do they get people to this automated system? Where does the customer awareness come from?
Their advertising strategy is very focused. It's heavily concentrated on meta platforms. Facebook and Instagram are huge in the Philippines. And the goal of every single ad is to drive people directly to download and use their mobile application.
Funneling everyone to the app.
Exactly. That way, they keep control of the customer relationship, they gather all that valuable sales data, and they make the buying process super smooth, whether you're a big hotel chef or just someone ordering microgreens for home.
Now, relying this heavily on automation and tracking sales data, that demands some serious back-end accounting, right? How transparent are they being about the financials, especially for potential investors?
They're using software called BIMP. The sources describe it as being similar to the 1C accounting system, which is apparently a pretty powerful, widely used system in Europe and Asia for handling complex accounting and inventory all in one place. It allows for accurate, real-time tracking of stock levels and costs.
Okay, but the key thing for an investor is, can they see what's going on?
Absolutely. And this is a major selling point in their pitch. They're promising to give investors real-time, online access to the main financial reports: cash flow, the P&L, profit and loss, and the balance sheet.
Real-time access.
Yeah. So investors don't have to wait for some quarterly report. They can literally log in anytime and see the farm's financial health, check the cash burn rate, see how the margins are performing. That level of transparency builds a lot of trust, especially in a fast-growing, capital-intensive business like this.
And it sounds like their overall planning reflects that kind of mature approach, too. They're not talking about crazy, rapid blitzscaling like you sometimes see with tech startups.
No, definitely not. They're looking at a 5 to 10-year horizon. They seem to understand that even though the tech itself is fast, scaling up the physical farm, getting the cultivation right for different crops, that takes methodical, steady growth. They're clearly prioritizing consistency and minimizing risk over just expanding wildly.
Okay, now let's get into something that sounds unique: the marketing flair. We heard a rumor about classical music for the plants. And tell us about this InstaWall. What's that about?
Right. It's a clever blend of, science and showmanship. The environment itself is designed to be calm, maybe a bit quirky. Yeah, classical music playing for the plants definitely creates a memorable vibe. But the real marketing tool is this physical centerpiece in the farm, the InstaWall.
So it's literally a wall designed for Instagram photos. Neon lights, green backdrop.
Exactly. It's explicitly designed as a visual hook for social media. And given the founder's background, apparently they have experience as a model and dancer, the plan is to actively leverage that. Bring in media people, bloggers, local celebrities for photo shoots, collaborations, events right there at the farm.
Okay.
It basically turns their working farm into this high-visibility media location. You can imagine the free publicity that generates in a market like Manila, which is incredibly active on social media.
Okay, but let me play devil's advocate. If I'm an investor looking at a serious B2B supplier for top restaurants, does relying on an InstaWall and celebrity appearances risk making it seem a bit gimmicky, not like a reliable agricultural business?
That's a fair question. It's a potential challenge, right? But I think the key is who they're targeting with that specific tactic.
Yeah.
The InstaWall, the celebrity stuff that's primarily aimed at the B2C market, the individual consumers. And remember, that segment is projected to be about 35% of their total revenue.
Okay.
So that strategy builds brand awareness, makes it desirable for those health-conscious folks ordering through the app. But for the B2B clients, the chefs, the hotel purchasing managers, what matters to them is the guaranteed daily supply, the consistency of the product, the fact it's pesticide-free, the quick delivery. The tech and the logistics speak for themselves on the B2B side. The InstaWall is more about reeling in those high-margin individual customers without undermining the professional trust needed for the bigger contracts.
Got it. So it serves a specific purpose for a specific segment. And how do they keep those individual B2C customers coming back? How do they build loyalty through the app?
The mobile app is really the hub for loyalty. It lets them do sophisticated things like segmenting customers, sending out targeted push notifications with relevant offers. They use the standard tools you'd expect, discounts, cashback programs to incentivize people to order again and again.
Mm.
By managing that 35% of their business directly through the app, they build this ongoing digital relationship. It helps make sure those private clients stay loyal and don't just drift off to buy imported stuff from the big supermarkets next time. It's like building a digital fence around their most profitable individual customers.
Okay, let's really dive deep into the money side now, the investment they're seeking. 58 million Philippine pesos, and that's meant to fund the scale-up over 36 months, starting around August 2025. How is that big chunk of capital, that million plus USD, actually going to be used?
Right, so that 58 million pesos breaks down into three main buckets. First, equipment and setup. About 13.75 million pesos is earmarked for buying the initial 15 vertical shelves, all the fancy lighting, the automation controls, that sort of thing. Second, site prep. Around 3.21 million pesos covers the initial rent, security deposits, and any necessary repairs or fit-out needed to turn their BGC space into this clean, controlled environment farm.
Okay, but that adds up to less than 17 million. The vast majority, like over 70% of the investment, is allocated to working capital. That's 41 million pesos. That seems like a massive amount for working capital. Why does a high-tech farm need such a huge buffer?
That 41 million is crucial. It's basically the engine oil and the safety net that allows their conservative growth plan to actually work. It covers several really critical things during that ramp-up phase. Staffing. You need to hire experienced farmers, technical staff who can manage the automation. You have to pay them while the farm is still getting up to speed and not generating full revenue yet. Inventory for resales. Remember those nuts, dried fruits, and maybe initial batches of premium stuff like strawberries they plan to resell? They have to buy that inventory up front. That takes cash.
Okay.
Marketing. Yeah, the install is great for buzz, but landing those first crucial contracts with, say, 1 to 3 big supermarkets, that requires a serious, sustained digital marketing push that costs money over time.
Makes sense.
And probably most importantly, operational buffer. It covers all the day-to-day running costs during that initial period where the company knows and projects it will be running at a net loss. It's the cushion against inevitable startup hiccups and delays.
Speaking of losses,
Yeah.
the projections for 2025, that first partial year, show a net loss of over 20 million pesos. That's a significant starting hole.
It is, but it's entirely planned for and expected. It's a direct result of spending that big chunk of capex upfront, over 18 million pesos just on equipment and setup, while only having 5 months of initial revenue coming in, projected at about 5.1 million pesos for 2025. High fixed costs, limited production slots online, that equals an initial loss. It's standard for this kind of build-out.
But then the model shows things changing dramatically. Revenue jumps from that 5.1 million in 2025 to nearly 148 million pesos, 147.9 million in 2026. That's wait, like a 2,800% increase in just 1 year? How is that even possible? How do they justify that kind of explosive growth?
That massive jump comes down to 2 core things happening. First, the farm hits full operational capacity. All 1,800 of those growing slots are up and running, churning out produce.
Right.
Second, it assumes they successfully achieve those conservative daily sales volumes we talked about consistently.
Yeah.
Once the physical infrastructure is running, the sheer efficiency of hydroponics combined with that super fast 12-day microgreen cycle just allows revenue generation to scale up very quickly and become highly predictable if they hit those modest daily sales targets.
And that efficiency, even on those seemingly small volumes, drives really high profitability.
Exactly. By 2027, the projection is for their net profit margin to hit a very healthy 40.5%. And the reason for that lies in the basic economics of the microgreens themselves. Their projected gross margin on microgreens is astonishing, over 89%.
89% gross margin.
Yeah. Once the racks and lights are paid for, the actual cost of seeds, nutrients, a bit of power, it's minimal. So almost 90 cents of every peso they get from selling microgreens is gross profit. And that super high gross margin means even those conservative daily sales volumes start generating significant net profit very quickly once the fixed costs are covered.
So when do they actually cross that line? When does the operation become profitable day to day? When's the break-even point?
The operational break-even, the point where they actually start making a clean profit each month, is projected remarkably early, October 2025.
October 2025, that's only, 3 months after the forecast starts in August?
Exactly. That high margin on the core microgreens product allows them to cover their fixed running costs very, very quickly.
Okay, let's quickly revisit those sales scenarios they used. The whole model is built on 3 possibilities, right? We know the baseline is conservative.
Right. They map out a spectrum. The pessimistic scenario is based on achieving just 1 million pesos in sales per month. The realistic scenario, which underpins most of the main projections we've discussed, targets 2.5 million pesos per month. And then there's an optimistic scenario aiming for 7 million pesos per month.
And that high profitability, that rapid break-even, that's based on the realistic scenario.
Yeah.
Which is only about 2.5 times higher than the absolute floor, the pessimistic one.
Precisely. Which brings us back again to that core message about how achievable these volumes are. We really need to stress this for anyone evaluating the opportunity.
Yeah, let's nail it down.
To hit that realistic sales target of 2.5 million pesos a month, what do they need to sell? They need to consistently move 80 kilograms of microgreens, 40 kilograms of mushrooms, 40 kilograms of wet greens, and 40 kilograms of those nuts-dried fruits every single day.
Right.
Now think about Metro Manila again, 35 million people, thousands of restaurants, hotels, supermarkets. To sell that amount daily, securing solid contracts with just 1 to 3 major supermarket chains could potentially absorb that entire output, or maybe the combined needs of 5 big luxury hotels.
Yeah.
They are proving the model's viability based on achieving just a tiny sliver of penetration in this enormous economy. The confidence isn't in some heroic market takeover. It's in the predictability and stability of selling that small, reliable, diversified basket of goods every single day.
Okay, crystal clear. Now let's look at how an investor can actually get involved. They need 58 million pesos. There are 2 main options presented, right? Let's start with option 1, equity. Buying share of the company, they're offering 25%.
That's right. Option 1 is buying a 25% stake. This is really geared towards an investor looking for growth potential. Over the 36-month forecast period, the projected cumulative internal rate of return, the IRR, is 162.4%.
Okay, hold on. IRR, 162.4% cumulative. Let's quickly break that down for listeners. What does that actually mean, and why is there also an annual figure?
Good point. IRR is basically the effective annualized rate of return you expect to earn on the investment, considering the timing of cash flows. That 162.4% is the total return anticipated over the full 3 years. But for comparing it to other investments, the more useful number is the investor annual IRR, which they project at 25.16%. So you should really compare that 25% annual figure against what you might get elsewhere in the market. And 25% annually from an agriculture-based venture. That's very strong.
Okay, 25% annual return target. And when would an equity investor expect to get their initial money back, the payback period?
The projected payback period is 14 months. So they anticipate the investor getting their initial 58 million pesos back by October 2026.
And the upside beyond that?
The big potential upside comes from the company's projected valuation. By the end of 2027, they forecast the whole company could be worth 338 million pesos. So the investor's 25% stake would theoretically be valued at 84.5 million pesos at that point. That's the potential capital appreciation.
Okay, that's the equity route. Now, what about option 2? Debt, just lending them the money. It's a loan at 25% APR.
Exactly. The debt option is structured differently. It's aimed at an investor who prioritizes security and predictable income. It's a 24-month loan carrying a fixed 25% annual interest rate.
Okay, but the investor IRR listed for the debt option is 42.9%. Why is that higher than the 25% interest rate? It doesn't quite add up immediately.
Ah, good catch. That higher cumulative IRR on the debt comes from a specific feature in the loan structure. They're offering an initial 6-month grace period where the interest isn't paid out, but is instead capitalized, added to the principal.
Oh, interest on the interest.
Basically, yes. You're earning a return on that deferred interest during the grace period, which bumps up the overall effective return, the IRR, over the life of the loan to that 42.9% figure, even though the stated interest rate is 25%.
Clever. Okay, but how safe is this loan? If I'm lending them 58 million pesos, I want to know I'll get paid back. Let's talk about the security. You mentioned DSCR.
The security looks very solid based on their projections. The average debt service coverage ratio, or DSCR, is calculated at 2.54.
Okay, translate DSCR for us. What does 2.54 mean in plain English?
DSCR tells you how many times over a company's available cash flow can cover its debt payments, principal, and interest for a given period. A DSCR of 1.0 means they have just enough cash to make the payment. Anything below 1.0 means trouble.
Right.
Generally, anything over 1.25 is considered okay, and over 1.5 is seen as pretty comfortable. So a DSCR of 2.54 is excellent. It means that for every single peso they owe in debt service, they expect to have 2.54 pesos in operating cash flow available to pay it. That's a very healthy buffer.
Okay, that sounds robust. And what about collateral? What's backing the loan if things go sideways?
The collateral package is also very strong. It includes the physical equipment, which is valued at 40 million pesos. Plus, there are personal guarantees from the company founders. When you add it all up, the collateral provides coverage estimated at 254% of the loan amount.
254% coverage.
Wow.
Yeah. So between the strong projected cash flow coverage, DSCR, and the extensive collateral, the debt option appears very well secured. They've clearly structured both options to appeal to different investor preferences, growth versus security.
Okay, so we've talked about the potential. But every venture has risks, especially when relying on high-tech systems in a challenging environment. What are the big operational risks here? Like dependence on electricity seems like a major one for a vertical farm. How are they planning to handle that? That's definitely risk number one. A long power outage could wipe out the entire crop very quickly. No light, no nutrient pumps, no climate control. It's catastrophic. Their mitigation strategy is straightforward. They've specifically budgeted funds within that big working capital pool to purchase high-capacity diesel backup generators and also UPS systems, uninterruptible power supplies for critical components. The goal is seamless, continuous operation regardless of grid issues.
Okay, backup power. What else?
While protecting the assets themselves, they plan to take out a significant equipment insurance policy covering up to 40 million pesos. This protects the core capital investment against physical damage from things like fire, typhoons, or major equipment failure.
Right. What about market risks? Competition popping up once people see this works. Or maybe price pressure from cheaper imports, even if the quality isn't as good.
Their defense against that is twofold. Sticking to the premium end of the market and leveraging their unique logistical advantage. They're not trying to compete on price with commodity vegetables. They're selling freshness delivery on the day of harvest, which imported stuff shipped over a week or more simply cannot match. And they're focusing on those specialized, high-margin items like specific microgreens or eventually those rare crops like Japanese cucumbers. That creates a niche that's harder for basic competitors to copy. Their BGC location itself is a barrier to entry for distant competitors.
Okay, and what if things just take longer than expected? Delays in getting the facility fully operational, hitting those production targets, that happens all the time with startups.
That risk is primarily mitigated by, first, that very large 41 million peso working capital buffer we keep mentioning. It gives them breathing room. Second, the financial projections themselves are built on those conservative growth assumptions. Success isn't dependent on everything going perfectly according to a super aggressive timeline. And third, they're planning to hire experienced people, possibly bringing in skilled farmers from established agricultural areas like Baguio or Laguna. Good staff minimizes the chance of technical mistakes during setup and scaling.
Makes sense. Beyond the operational stuff, what about protecting the investor's interest from a corporate governance perspective? Especially if you take the equity stake, how do you ensure the money is used properly?
This is where the founders seem quite open, which is a good sign. They've indicated they're agreeable to the main investor appointing their own financial controller, someone who can sit inside the company and monitor the finances directly.
Okay, that's significant oversight.
Very. And furthermore, they're willing to put in place a strict spending control, requiring dual signatures, likely one from management and one from the investor's appointee for any large expense over, say, 1 million pesos. This provides a direct check against any misuse of funds or major unapproved spending.
Right.
And there's a subtle point for the equity investor, too. Because this new 58 million peso investment is so large relative to the initial capitalization, it significantly dilutes the ownership percentage of the original smaller corporate partners.
Ah, so the new investor becomes the dominant minority shareholder.
Pretty much. This actually reduces the risk of potential interference or conflicting agendas from those earlier partners, giving the new main investor a clearer line of influence with management.
And for the loan investor, we already covered the security, the high collateral, the excellent DSCR. They seem well protected.
Exactly. That DSCR of over 2.5 means even if sales dip a bit below the realistic forecast, the cash flow should still comfortably cover those fixed 25% interest payments. The loan looks very secure on paper.
Okay, so let's fast forward. Assuming this all goes well, how does an investor eventually get their money out? What are the exit strategies? This isn't like a tech startup you flip in 18 months.
No, definitely not. The founders are upfront about this being a longer-term game. Agriculture takes time. They're thinking a 4 to 5 year horizon is realistic, aiming for those steady 25–35% annual returns along the way. Option 1, the main plan, is a sale of the investor's stake, that 25%, to a strategic buyer sometime after 2027. Who would that be? Well, think about the major supermarket chains they're supplying, Daily, SM, Landers, S&R. One of them might want to buy the stake to secure their own premium local supply chain.
Vertically integrating, essentially.
Exactly. Or it could be a large international agricultural fund looking for a proven and profitable entry point into the Philippines market. They'd be attracted by that high projected company valuation of 338 million pesos by then.
Okay, that's the primary exit. What if a strategic buyer doesn't materialize right away?
Option 2 is more flexible. It could involve the founders buying back the investors' shares, perhaps using company profits or raising further funds. Or it could be a partial sale to a third party, maybe a smaller private equity firm that's happy with stable cash flows rather than needing a full strategic acquisition. It allows for a more negotiated private exit.
And the long shot, the ultimate goal.
The ultimate long-term vision, maybe post-2028, is option 3, an IPO. Listing Metro Greens on the Philippine Stock Exchange, PSE. Once they have a track record of several years of stable operations and predictable profits, an IPO becomes feasible. That would provide the biggest potential liquidity event for everyone involved and really validate this whole high-tech urban farming model in the region.
So it seems pretty clear. Metro Greens has mapped out a really comprehensive approach. They're tackling major local risks, tricky logistics, unpredictable weather, supply chain gaps by focusing intensely on that prime BGC location, leveraging high-tech efficiency, and crucially, diversifying their products.
Absolutely. And what makes the whole financial case so compelling, I think, is that inherent modesty we keep coming back to. They're not pitching some fantasy based on capturing half the Manila market. They're demonstrating that the predictable daily sale of these achievable, relatively small volumes, that 80 kilos of microgreens, the 40 kilos each of mushrooms, wet greens, nuts, and fruit is enough. In a market as massive, as premium, and as underserved as Metro Manila, consistently delivering that small, diversified basket is the reliable path to potentially explosive financial returns. It really underscores that in this context, the guarantee of supply is where the real value lies.
So if we accept that these kinds of high-margin, diversified, relatively small-scale urban farms are viable, even highly profitable, it does make you wonder, doesn't it? What scale of this kind of localized, high-tech production would it actually take to meaningfully shift the food security equation? Not just for Metro Manila, but for all the other densely populated, import-reliant meganocities across Southeast Asia.